What's going on, everybody? Good evening. Good evening, Gail. Good to see you. Welcome in. Good evening, Lloyd. Welcome, welcome. Welcome in, everybody. We're going to get going in just a couple of minutes here. How's everybody doing tonight? You able to hear now, Alex? Might have been quiet as why you weren't able to hear anything. Just waiting 1 or 2 more minutes before before we get started. Cool. All right. I'm going to send out one more message letting everybody know we are getting right into it, and then we'll get going. Give me 1 second. All right. Yeah, let me get this message sent real quick, and then we'll get right into it. All right. A couple minutes after the hour, let's go ahead and get started. Welcome in, everybody. Welcome into the lecture for the evening. For those of you who haven't been to one of my classes before, my name is Tostie. We cover a lot of different topics in here. Sometimes, about 50% of the time, we do like a PowerPoint focused class. Other times, it's going to be mostly chart focused, which tonight we're going to spend the majority of our time on the charts here. I may have a couple graphics that I pull up here and there just for a quick reference, if I even have them available. Yeah, I do. But yeah, from time to time, we might pull up just an image or two for reference, but for the most part, going to be mostly a chart-focused class. In general, this specific lecture is going to be mainly focused on price action. Last week, we talked a lot about, we talked a lot about FOMC And then we also covered kind of the basics of candlesticks as well in terms of strength and how to determine kind of a strong bar versus a weak bar and how to identify a strong reversal, strong breakouts, that sort of thing. So that was the focus of our last class. This time around, it's going to be a little bit more different. We're going to put some of the pieces together in a bit more of an advanced setting and help you guys understand a little bit of a, kind of set of rules, I'll say, for determining kind of the direction of the trend as it relates to any individual asset. So let's get going, everybody. To start us off, here we're looking at the S&P 500 ETF SPY. This one in specific represents the S&P 500, if you're familiar with it, which is 500 to sometimes it gets up to the 502 of what are considered the most largest and impactful companies in the United States market. So anyway, what we're looking at here is a representation of the price action of that given asset for the past couple months here. And on the chart here, you can see obviously candlesticks. We talked about those in the last lecture. As well as this little moving average ribbon. And this can be referred to as kind of an EMA cloud. This is really the first step for me in determining short-term price action trends. And again, I'm just going to introduce all these concepts at a high level quickly before I dig into some of these things in depth. Next up, kind of the next standard set of moving averages that I use is the 20, 50, and 200 moving average. These ones typically are used for kind of a longer term trend identification. These ones can be super, super powerful when used in conjunction with each other. So definitely another set of MAs to be looking out for. So with that said, I gotta disable that. Remember how to get the annotation off. Clear. There we go. Cool. All right. So anyway, those are kind of the first two pieces of information that we're going to look at is these longer term moving averages as well as the shorter term EMAs. So let's talk longer term moving averages. First and foremost, moving averages in general represent, or at least simple moving averages represent effectively a simple average of price. So for example, we're looking at the 20 moving average in yellow, 50 moving average in orange, and the 200 moving average in red. And for example, the 200 moving average takes the last 200 price action closes on whatever time frame that you're looking at, divides it by 200, and plots a moving average there. So you can see right now the 200 MA is at 440. So the last 200 closes of the weekly chart added together, divided by 200, gives us an average price of about 440. And same thing for the 50 and same thing for the 20. And the significance of these moving averages is they typically are very commonly used to represent the long-term trend. And what I mean by that is, generally speaking, you want to see these moving averages all aligned in some sort of orientation. And just to define that a little bit more, you can see right now we have the 20 moving average in yellow, 50 moving average in orange, and 200 moving average in red, all aligned from shortest term moving average closest to current price action and the longest term moving average furthest from price action. And what this represents is generally a strong confirmed uptrend. And we could zoom out past 20, 30 years ago, and you can kind of see how this has been reflected. For example, once we see these moving averages begin to cross below each other, so this example here, if we zoom in a bit, we see this 20 moving average cross below this longer term 50 moving average. Periods following that have resulted in a continued downtrend, right? And here we get all of these moving averages cross the downside, which effectively represents a kind of full bearish confirmation of trend. And we really didn't start to get any strong bullish momentum until we started to see these moving averages cross back in a positive formation. And ever since then, we had a nice uptrend, right? As you could follow this price action along, nice uptrend when all these moving averages were stacked to the upside. And then again, right, once we start to see some of the weakness in the MAs, we start to get that downtrend. And this cycle repeats over and over again, right? You could look back on the cycle of price action for any given asset, and you can see these sort of patterns repeat. And the framework that I really want to outline is this is really mostly, for me personally, something that I'm looking at for long-term trend identification and also for long-term entries and exits. Just to define that a little bit further, as you can see, when we have all these moving averages stacked in a way where the short-term moving average is above all the long-term moving averages, generally speaking, that represents a strong uptrend. And again, I'm not going to go back test every single example of this, but it's pretty evident when you go through and look back through all the price action on any asset over the last 20, 30, 40. I mean, you could even go back further, 50, 60 years. And I guess I'll provide the example really quick just on SPX, just to really illustrate how crazy this really is. I mean, we can just go back and look at, I guess, look at 1980, because that seems like that makes sense. Zoom in a bit here. Cool. So right now we are looking at price action all the way back in 1980. We could even go back further. Let's just look back to the 50s just because we can. We have all this great information. A bit messier, but let's just zoom out a bit. So this is weekly price action data from 1950. And notice again, right, this same pattern repeats. Once we get the short-term moving averages all above the long-term moving average in order, that typically results in a nice long-term uptrend. Once we start to see some weakness in those moving averages, like here, for example, you see the short-term moving average crossing below the medium term, we get that short-term weakness. And remember, again, this is the weekly candle time frame. And again, right, this same pattern repeats over and over again. We get the short-term moving averages all back above in the right order with the 20 above the 50 above the 200. Nice long-term positively trending price action, right? And this sort of pattern, I mean, we're back in 1955 right now. This is not something that's new to the market, right? This is something that has been around for a very long time. It's nothing new. Yeah, this is really just the way things are. And the reason that this sort of thing matters and this sort of analysis can be valuable is because looking at these moving averages on these higher time frames helps us understand what the trend is at a high level, right? Some of you guys may have heard in my lectures or in other lectures that it's important for us to understand what the trend of price is on any given time frame, so we understand if we're working with the trend or against the trend. And that should heavily influence the type of management style that we use for our trades. For example, when you're trading with the trend, generally speaking, the probability of you being right or being successful in that trade is typically higher, right? You can think of it like I don't know, a train moving in a single direction, right? It's going to be pretty hard to stop that train and turn it around if it's going 60 miles an hour. And you could think of this sort of trend when we have the 20 moving average above the 50 moving average above the 200 moving average, a train moving at 60 miles an hour. It's going to take something significant to stop that train and turn it the other direction, right? It's not like you can just put your car in front of it and it's going to stop, right? It wouldn't. It'd plow right through it. You would need another train going the other direction at 60, and then it would probably stop and turn around. Anyway, maybe a little bit too much emphasis on that analogy. But regardless, what I'm trying to get across here is that this is really, in my opinion, the first place to start when analyzing price action. The term price action is pretty all-encompassing. It can have a lot of different definitions, but simply put, price action represents the movement of price and volume, in my opinion, for any given asset or equity. And the best way to analyze that on a long term is figuring out what the trend is. And these moving averages can be that first really important tool to figure out where that probability lies in terms of the direction of price. And there's plenty of back tests that you can run. I know we just cherry picked a couple examples, but there's plenty of back tests that you can run. Generally speaking, if you buy only when these moving averages are stacked all in the right direction, with 20 above the 50 above the 200, and you sell on events like this, when the 20 moving average crosses below the 50, there's actually a back test that I ran personally that showed that you outperformed the SPY, right? You outperformed buying and holding the SPY by doing that, very simply put. So it's super powerful. It's incredibly accurate. It's a long-term kind of strategy in order to analyze price, and certainly the first step and kind of fundamental to understanding how to understand the trend of a given asset on a higher time frames. I feel like I said a lot of big words and a lot of vague stuff there. So I want to take a quick pause. Any comments or questions up to this point? What are your guys' thoughts on this? Is this new information to you all? Is this something that you've heard before? What are you guys thinking? Can I repeat that last piece? Yeah, I'll restate it after I get these questions. Cool. Okay, so to try and rephrase this simply, let me write it down. Maybe that'll help. So what I like to call kind of a full bull trend, I'll write this down here, full bull trend. You want to see the 20 moving average above the 50 moving average, above the 200 moving average on weekly time frame. So let's write that out, kind of base case, right? For a full, strong, bullish trend, you want to see these moving averages stacked in this exact order, where again, 20 above the 50, above the 200. And another plus is having every single one of them have a positive slope or trending in the upwards direction, right? That is kind of the cherry on top. So now we have that established kind of officially in writing. So now let's talk about kind of clarifying. I'm trying to think of what I want to say here. Anyway, let me reset my brain real quick. First of all, again, as I mentioned, this specific ordering of the moving averages represents a full bull trend on the higher time frames. Again, the reason that's important, and I'll write as I type, this is important. If we understand the trend on the higher time frame, and this trend is clearly strong in one direction, we automatically know where the higher probability trade lies. There we go. As I mentioned, right, if you are trading with the trend, automatically you have a higher probability of being right. Generally speaking, that trend is going to be up, right? And probably 70 to 80% of market conditions, that higher time frame trend is up. However, there's plenty of times when that's not the case, such as all throughout 2022 into mid 2023. And there was a about mid 2023. And there was a reason that buying the dip and trying to get long throughout this time frame was very difficult. And that's because the long-term trend is no longer strong to the upside, right? Simply put, you can see in a bull market, right, it's pretty typical for us to hold this weekly 20 moving average as support. And you'll notice once we lost that weekly 20, it very quickly resulted in a further breakdown, which was confirmed by that 20 finally crossing below the 50 weekly. As you can see here, in recent pullbacks, we've held right at the 20, bit of an anomaly here where we broke below it, but this is the general idea. I'll take a break. Does that help, Gail? That make a bit more sense when I restate it that way and kind of write everything out clearly. Perfect. Okay, so as a trader, right, this is the first thing that you should be mindful of, no matter what type of trade you're taking. You should understand the long-term trend of whatever asset you're looking at. And we can repeat this for a lot of things. Something like Rivian, right? Rivian doesn't have a 200 moving average yet, but you'll see over the past multiple months, that 20 has been below the 50. And as a result, dip buys have been pretty difficult, right? With, I don't want to say shit stocks, but with shit stocks like this, you're going to get crazy moves to the upside and to the downside. But generally speaking, right, you are going to be very well rewarded by just being patient and waiting for these moving average to trend in a positive direction, right? I think the most important lesson to take from this is that when analyzing these higher time frames and taking a look at these weekly moving averages, buying the exact bottom is much less important than buying the strength after the exact bottom. And if you learn or remember nothing from this lecture, that's the one lesson I want you all to take from this is it's not important to always buy the dead bottom. It's much more important and much easier to buy the strength after that bottom because it's really, really clear. It's very obvious once that bottom is put in. Again, you can see this repeated on Google, right? Very clear here, right? We're making some constructive moves out, but somebody could easily say, oh, this is the bottom, right? We're breaking highs, right? Somebody could easily said, oh, this is the bottom, right? Bottom is in right here. We're breaking highs again. So that's two opportunities to be wrong. Here, you could have said this is the bottom, and yeah, you would have been right? You would have gotten, about a $10 cheaper entry. However, if you waited till here, right about this week, once you can see that all the moving averages are now trending in the positive direction, as a long-term trader, I can go ahead and buy at this point. The trend is clearly up. Maybe I'm going to be wrong. Maybe I won't get the most optimal buy point. But in general, you need to reset your frame of mind to now be looking for those opportunities to the upside. And there's plenty of ways that you can structure this idea in a more logical way to get a more optimal buy point. For example, looking for key levels and maybe buying a pullback into those key levels once the trend is established to the upside. But again, right, the purpose of this lecture isn't necessarily that, but rather being able to understand when there is a favorable condition for you to actually execute a trade. Cool. So that's another example. We got another question. Can this be used on smaller time frames? The answer is yes. However, me personally, I prefer to kind of shift my frame of mind and look at shorter term moving averages when paying attention to smaller time frames because I want to be a bit more precise, right? So generally speaking, my workflow when looking for a trade is identifying the higher time frame trend, right? For the S&P 500 and pretty much most other names in the market right now, that trend is up, right? So automatically, your bias should, generally speaking, be looking for longer term trades to the upside. That doesn't mean that when we're trending positively on the weekly time frames, you should be YOLOing, weekly calls every day, right? That's not what this means. This means that you should be looking to buy dips to reasonable levels of support. You should be excited about those. And there should be no fear considering the weekly trend is still up. And you should be looking for opportunities to buy continued strength, right? So breakouts, continued moves higher, holds of key levels, that sort of thing. Conversely, right, if all of these moving averages are trending to the downside, or some of them are beginning to trend to the downside, like here, you should either be looking for short opportunities, right? So buying puts, shorting stocks, or just sitting on the sidelines and being patient, right? Me personally, I'm not much of a bear, right? I just have the mindset that it's just so much easier to get long. It's so much easier to buy stocks or buy calls. So when the market is trending down, I just wait typically. And we haven't had an opportunity like we have back in 2022 in a while. But when the market's trending down, I just wait. I can be patient, right? I can wait for that next opportunity. I can wait for the moving averages to trend positively again. I'm not in a rush. It's okay. All right. So that is kind of my first step or kind of number one way to identify price action and then the long-term trend on the higher time frames. Everybody good with that before we move on to shorter term? And then we'll start to talk through some more specific frameworks for the short term. BST is different than Rivian. Thanks, Norman. Appreciate that. Everybody feeling all right? Cool. Vigilance feeling good. Cool. All right. I'll take everybody's silence as them feeling good about this first concept. So again, right, this is the first step of the workflow is identifying the long-term trend. Let's now zoom in to the shorter term, right? So we know based on what we just saw in the S&P, long-term trend is up, right? Now, what I like to do is start analyzing the short-term trend with a very similar framework, except just slightly different, right? We're just looking at a couple different moving averages. So me personally, what I like to do is throw up the 10 and 20 exponential moving averages. And those are going to be much shorter term and much more reactive than those 20, 50, and 200 simple moving averages. Reason that I like to use these EMAs is because they work for me and my strategy, right? The way that I like to trade is typically, 1 to 30 day swing trades, right? That's kind of my bread and butter. And as a result, the way that I look at charts is influenced by that. So what I like to do is look at these 10 and 20 moving averages, and you can see how they're plotted on the chart. When this cloud is green, it means that the 10 EMA is above the 20 EMA, indicating an uptrend. And when the 10 EMA is below the 20 EMA, this cloud is colored red, indicating a downtrend. Very, very simple stuff. I mean, this is really nothing groundbreaking. And I want to pull up this graphic really quick that kind of illustrates some concepts that I've talked about before. So this is from a book that I really enjoyed reading almost a year ago now. It's called, I think it's called, God, I don't even remember what it's called. Anyway, it's by this guy named Oliver Kell. He won the U.S. Investing Championship in 2020 and kind of wrote a book about his strategy. I thought it was interesting, so kind of incorporated some of the concepts into the way that I like to teach. And he also likes to use the 10 and 20 exponential moving averages. And he named some of the setups that kind of occur throughout this cycle of price action. So I want to just kind of talk through them. So obviously, there's a couple phases, right? There's always going to be trends to the upside and there's going to be trends to the downside. And within each of those trends, there's going to be different stages. So you can kind of see, I want to start here, right? Let's start with a new uptrend. Generally speaking, with a new uptrend, there's going to be some first kind of initial pop or break back above the moving averages. Then the moving averages are going to turn into some kind of positive trend here, where we get the 10 moving average above the 20. This setup is called the EMA crossback. So that first kind of dip into a positively trending set of moving averages. From there, it's pretty common to see some kind of consolidation or flags back into the moving average. And typically speaking, the climax or peak of the trend is some kind of blow off top or strong move to the upside that extends very far from the moving average. And this cycle over time repeats. Some of these steps are left out sometimes. Sometimes you don't get this retest of the moving averages. Sometimes this phase downtrend lasts very quickly. But generally speaking, we could see this exhibited pretty nicely just in this short-term trend. And I want to just kind of compare these two graphics here. So let's do that. All right. So comparing these two here, let me see if I can resize this just a little bit better. So here, let's label our cycle of price action. So what we're first looking for is this break below the moving averages, which it looks like we kind of got this right about here. This was that real first drop below the moving averages. And it is a little bit of a mess, right? One thing to note is that what we see in the market is not always perfect. In this case, right, we have some elevated volume here. So above average volume down here. And we break below the moving averages here, right? This is going to be our first kind of red flag. I wouldn't necessarily call this the wedge drop though, because we didn't actually kind of make it below the moving averages and then hold them as resistance until right around here. But this is really the first red flag is now, or the first confirmed red flag. Here in this area, we have a declining set of moving averages. So the 10 and 20 moving averages are now in a negative trend, and we're rejecting these areas as resistance. So at this point, this is absolutely a confirmed downtrend until proven otherwise. At which point, the only way to really confidently get long at this point is to see some break back above the moving averages, with the moving averages beginning to trend positively. So here, you could consider this maybe the EMA crossback phase, where the 10 EMA now cross below the 20. We consolidate in this area. Again, super, super messy. Just a great example of how imperfect this can be sometimes. And then ultimately, we break down. Here, this phase was pretty quick. We have this clear reversal extension where we move incredibly far from the moving averages. Incredible distance from the moving averages here. I mean, this is a really, really big extension here. When we opened on this day, we can just take a look here. At the open of this day, we were about 5% away from the moving averages, which that's a really big extension. You can see on average, we're approximately, just on an average day, we're about, 1 to 2% away from these moving averages at any given time. Once we start to get a bit further from these EMAs, it really starts to get in extension territory. So here we can see where we were at, still at about 1%. Here we can see where we're at, just passing that 2% threshold. So even on these big kind of green or red days, it's pretty uncommon to see us move this far from the moving averages. So this would be kind of that reversal extension phase, which is pretty commonly regarded as a turning point in price action, right? And the reason that this is a turning point is because these are days where a lot of sellers exit the market, right? A lot of selling takes place. And when we see this high volume, big reaction from buyers, that represents buyers really beginning to actually step into the marketplace and being able to start to take control of price action. So per this specific guidance, right, there wasn't really any valid buys here, right, in terms of a cross back above the moving averages. But once we get into this specific day right here, right, we're extended from the moving averages. However, we get this first cross back above with the 10 above the 20. And if you wanted to be patient, the first real buying opportunity is this retest of the 10 EMA, which is going to be that first EMA cross back, right? Here, it was a bit difficult, right? Definitely as a long-term swing trader, you would have got a nice entry off this 10 EMA, but it wouldn't have lasted very long. I'd like to think you'd trim at this level of resistance, but ultimately the very next day, you would have gotten slapped around, right? And here is kind of another example of that cycle of price action, right? Again, we break down back below those EMAs, starts to be a little bit higher to be a long trader, or a little bit more difficult to be trading long or to the upside. And then once we break back above these moving averages, again, very clear reversal around this area, right? You don't see a candle like this all the time that has this massive wick to the downside and big green bar closing near its highs on above average volume. This is a pretty clear reversal. And also we have our moving averages trending positively on the very next day. This would be our very first EMA crossback, where we break above and retest those positively trending EMAs. Again, another excellent buy point, right? Right when we reestablish that uptrend, this is the place to be looking long. And the reason that I didn't really mention any short trades is because if you remember from our longer term time frame analysis, it's going to be more difficult getting short on these sort of names that are in these longer term uptrends. So you got to be really considerate about that, right? You can certainly get short on any name at any time, especially when these trends shift to the downside. However, it's always going to be more difficult trading short when the long-term trend is to the upside. Does that make sense to everybody so far? Cool. All right. I want to highlight another example that's a little bit counter to what we talked about, at least as it relates to the weekly time frame, and just show how these rules aren't always set in stone, right? There's times when sometimes it makes sense to get long on some names for other reasons, right? So on Tesla, if we take a look at the weekly moving averages, the 20, 50, and 200, it's pretty clear that until really this week or the prior week, this thing was in a full-blown downtrend, right? I mean, there's no way around it. Literally last week was the first time that it had started to exit this full-blown downtrend. And the thing that's notable about this is this 200 weekly moving average is a key level of support and resistance. I mean, very, very important. And as a result, it should be treated as such. And there's absolutely opportunities to take trades either to the upside or downside in the marketplace, even if we don't have that full alignment on our weekly moving averages. And you can see we're starting to get the beginnings of what is a more positive trend, an early reversal here, where you can see that 20 crossing above the 50. We're still below the 200. However, we got that break above the 200 from the price action of last week, which again, very important level of resistance. And you can kind of see how that's looked on the shorter term EMAs, just again to kind of show what that looks like. As you can see, we've had a nice positive trend for the last couple days, or couple weeks, I should say. We are rejecting that 20 weekly moving average. We broke above that 20 weekly moving average on nice high volume, perfectly retested that next day, and then have now, since that retest, moved about 10% higher. So just wanted to give this example really quick that it's not always black and white, right? Just like anything in the market, it's much more of an art than a science. And these rules can certainly be flexible when it makes sense. So wanted to highlight that just because it doesn't necessarily fit in the box that we've established, and wanted to make sure that if you guys see an example like this on your own, that you're not shocked. All right. So that's most of kind of the fundamental concepts that I wanted to cover for now. I want to shift to you all and see what you kind of want to hear me revisit, what you want to hear about in more detail. If you guys don't highlight anything in specific, I'll just continue to talk about this cycle of price action graphic. I think honestly, this is one of the easiest ways to understand kind of the best. I guess what I'm trying to say here is that as a trader, you should identify where in a cycle of price action you are the strongest. Where in your kind of trading sort of strategies, where in your psychology do you fit in best, right? Is it easiest for you to pick out a bottom and buy this reversal extension? Or is it easier for you to be a bit patient and wait for that established uptrend when we get that EMA cross back? There's one other last thing that I want to talk about too. Do you ever use VAP intraday? I don't actually know what that means. Oh, volume at price? Um, I've never heard of that before, to be honest. VWAP? Volume at price. No. Oh, volume profile. Oh, yeah. Volume profile is absolutely something that I use. Yeah, super common for me to use the volume profile. Didn't cover it for now, but yeah, volume profile is an absolutely excellent tool for finding levels of supply, demand, support, resistance, whatever you want to call it, especially as it relates to an example like Tesla, where you can see as we broke over that 200 weekly moving average, also broke above a pretty nice volume shelf and held that as support additionally. So yeah, the answer is 100% certainly a great idea. Any other questions? Cool. If not, I have one other kind of even shorter term um, way to identify the current state of price action. Everybody feeling all right? Cool. All right. So let's talk about one kind of final framework that you can use. This one, I think we've kind of talked about it all. We've given kind of a framework for different types of traders. We've talked about, really long term traders. You could just use those weekly moving averages and you're pretty much good to go if you just want to trade off that, and you can be real patient, from the framework of like years. That'll work great for you. As a swing trader who's a bit more focused on the shorter term, 30 days approximately range, the 10 and 20 EMAs with that longer term analysis is definitely your friend. Let's talk now for day traders. Last thing that I want to talk about is the 5 simple moving average and looking at that as a day trader. So let me throw that up. And this is one that I've been kind of exploring a bit more recently. So not something that I've fully incorporated into my own trading just yet. However, figured I'd share it with you all. The 5 simple moving average from the daily, actually want to do this. Simple move or multi time frame moving average. We want to plot the 5 daily moving average on the hourly. Give me just a second. Isn't as smooth as I want it to be. Let me see if I have another study to make this look a bit better. I remember Empanada gave me one that was really good. Let me see. Yeah, daily SMA. I think this is what we want. Not quite. Unfortunate. Not getting exactly what I want from this. Should have prepared. Okay, well, I'll roll with this multi-time frame moving average, and that should get the job done. daily, simple, 5, and that. Cool. And let's zoom out. All right. So last thing that I wanted to talk about is using the 5 simple moving average from the daily time frame as a framework for a day trader. Rules behind this are as follows. What you want to see is a upwards sloping simple moving average with price trading above that moving average as well. And this isn't exactly what I want it to look like. Give me 1 second. I want to see if I can make it just a little bit better for you all, because this isn't exactly what I want it to look like here. Just to make it a bit more clear and really drive this home. Let's see. 1 sec to see if I can maybe pull up a bit better of a study for us. Okay. I should be able to do this. We go here, simple, and changes to 390. Sweet. Okay. Essentially, what I did is just recreate or replicate the 5 simple moving average from the daily with a 390 period 5-minute moving average. So you always have to take my word for it that this is the same as the 5 daily moving average. And essentially, the way to use this is very similar to the concepts that we've talked about all throughout the rest of this class, which is if you have a break above this 5-day moving average with an increasing slope, you should be buying dips and looking to get long. If you have a decreasing slope, 5-day moving average with price action below the 5-day, you should be either looking to be short or selling longs or staying out of longs in general. And you can kind of see how that's worked out just in the past few days. Here we have a bit of a kind of sloping downwards 5-day EMA or SMA, so maybe a bit of a fake out there. Here, same thing, nice trade there. Here we get that upward slope starting there. And obviously throughout that last uptrend, we could see that started a long time ago. So anyway, this is just kind of one other framework that a day trader could use to identify when it's more favorable to be either long or short. And again, the point of all of these sorts of analysis or lines of analysis, looking at these moving averages and referencing the trend is really to prompt you as a trader to buy strength after the dip, not just looking to bottom take the market, but buying strength after the dip has kind of completed, understanding what the longer term trend is. If it's still up, great, you can look to buy that. But yeah, that's really the big idea. And hopefully you guys are realizing that's the same kind of idea for all of these sort of strategies. Albert says, how do I time entries on the lower time frames for your swings? Yeah, really interesting question. Yeah, want to ask if there's any questions on this 5 SMA before I move on to that. Anything else on that? Even after ER? Well, Norvin, obviously ER is always going to change things. So, but after ER, I think technicals certainly can come back into the window. How can we use that 5 now that price is below? So right now, as of today, this 5 still is acting as support and the trend is still increasing. So as a result, you should still be looking long until we get a break below the 5. And that, I guess what I'm trying to say here is there's kind of a couple different scenarios here, and I'll write them out. 5 SMA scenarios. If we have price greater than 5 SMA and upward trending SMA, that's bullish, right? If we have price under 5 SMA and upward trending SMA, that's caution, not really long or short. If we have price under 5 SMA and downward trend, that would be bearish. And if we have price under 5 SMA and upward, that's caution as well. So there's kind of 4 scenarios here, right? You have the scenario when price is above the SMA and the SMA is trending upwards, which is going to be kind of that full bull case. You have when price is under the SMA, but the SMA is still trending upwards, which is going to be kind of that caution. You know, it's not necessarily bearish. It's not necessarily bullish. It's generally just neutral. Then you have price under the 5 SMA with the downward trend. That's going to be bearish. Then finally, if price is under the 5 SMA and the trend is upward, it's kind of a conflicting signal there, which is going to just be called caution or just kind of neutral. Cool on that, Aaron? What was the indicator I was using before the 5-day? Oh yeah, great question. So the indicator that I was using before this one was the technically called the EMA cloud. I will post that in the chat really quick. Let me go ahead and just find the link. This. Cool. So there's that study for the EMA cloud. This for me is, I do want to also kind of, what's it called? I want to add a little bit more to this. So maybe add like some kind of signal if we're just getting that crossover, something like that to make it easier to follow. But yeah, that's that. Norman, how to not get faked out? I think that's a really important question. With anything, there's always the risk of getting faked out, right? There's no signal that's ever 100% certain in the market, right? There's never going to be a case in the market where there's some specific indication where you know you're always going to be right. It's just not possible. And if somebody tells you that that's the case, they are probably lying to you, unfortunately. So in terms of how to know or how to have a higher probability of being right, you'd want a couple things, right? For example, as a day trader using all of the things that we just talked about, if you have those positively trending, 20, 50, 200 SMAs on the weekly, then you have the positively trending 10 and 20 EMA on the daily, then you have that positively trending 5 SMA on the shorter time frames, you pretty much have every case that things are going to go well, provided that you have some kind of validated entry. If you think that just because all those signals are in good condition or in the bullish condition, you can just go ahead and buy at any time that you want, that's absolutely unrealistic. And I think one point for me to convey here is that these scenarios and all these kind of strategies are really meant for you to get an idea of the trend of price and where price action should move in the future, right, based on probability. However, what we didn't outline today is how to actually find an optimal entry. That is still incredibly important and probably should be the topic of our next lecture, because that really could have its own topic. So maybe we actually focus on that next lecture, is talking about finding an optimal entry while also using these specific strategies. Because we really talked about how to use them, what they mean, but yeah, that is super important, right? Your trade plan still matters, right? Where you're going to enter, where you're going to exit, where you're going to stop out. That all can't just go out the window if you say, oh yeah, all the moving averages are trending positively, so I must be good. Unfortunately, it's not that easy. Also holding winning trades. Yeah, that's also an excellent question, Norman. And I think that's something that this sort of framework makes super, super easy. Holding winning trades is one of the more important skills in the market. And when you're using a framework such as this to identify and analyze the trend in price, it's pretty damn easy to hold a winning trade. Let's say, for example, and I'll just talk about one specific scenario to round out this lecture. Let's say, for example, your entry model is purchasing this, EMA crossback phase, this first move into the moving averages. For this specific scenario, you would have gotten long right around here, right? So this is the first kind of retest of those moving averages right here. You would have gotten long here. Your stop loss, realistically, if you're trading this sort of framework, should probably be below this low. Totally understood that that's not super realistic for everybody. And as a result, probably would honestly want my stop to just be below these recent highs right here. So this would have been that first kind of retest of the moving averages. If our stop loss was set below these recent highs, there's no way of getting around that we would have gotten stopped out right there, right? 100% that would have been a stop out, right? We would have been dead wrong. However, you got to continue to be nimble, right? So the very next day, when we break right back above the moving averages, and then the very next day and 2 days after that, we continue to retest them, there's no reason for you not to enter again, right? Yes, maybe you stopped out on that trade, but there's absolutely no reason to get back in, right? Very important to note, again, the market is an art, not a science. There's going to be times when things like this happen. Sometimes this isn't going to happen. Sometimes it is, but you got to be flexible. Anyway, with that said, once you get that entry, right, your target should probably be somewhere around these prior highs, somewhere around there. So you should be trimming some there. Then after that, you're setting new all-time highs. So probably could be using some kind of fib to calculate kind of future targets. And realistically, you should not be selling the rest of your position, or you should remain in some amount of your position until you get a signal that tells you that a top is in, right? For me, it probably would have made sense to sell once we break back below the moving averages. If not there, then here, once the moving averages trend negatively. But you should be selling along the way, right? But when you have this framework and you're looking, and this is for a longer term trade, right? If you're trading based on the daily time frame, you're not going to have a contract that expires next week. And you probably won't have a contract that expires next week, right? So you have the time to hold on to a winning trade, which is also really important. But anyway, if your entry model is this, where you're trading that break above the moving average and that cross back, so once we hit support, really, all you're doing is trimming at levels of resistance and holding as long as those moving averages are still trending positively and price action looks good, right? There's really nothing else to do outside of that. So honestly, to me, this is kind of the easiest way to be able to hold winners, but maybe some people don't feel the same way. Before I check those, Norvin, I'm going to make sure nobody else has any other questions. Any other questions or concerns before we take a look at whatever Norvin's talking about? Sure, our books. We'll talk about your name too. And you had earnings today. All right, we'll take a look at a couple names. All right, Norvin, we'll look at, Micron had earnings, Norvin, so there's going to be a pretty big move up after hours in a lot of those names. SMH, obviously that's going to gap up. MU's up 20 points after hours. SOXX, it's going to be the same as SMH. MU, there's not really much to say there. It's up $15 after hours. So yeah, I mean, it's going to rip. If you're in it, probably should sell some at 110. But yeah, I mean, in general, there's not too much to say about semis, Norvin. I mean, yeah, they're probably going to gap up tomorrow. You'll want to trade the reaction. So if you see a bunch of sellers at this 110, you could probably get short. If you see a break above 110, yeah, maybe you could get long. Yeah, Dell, that's been popping back up on my radar again. Dell's an interesting one. Starting to look actually kind of constructive, especially after this suspicious massive volume that poured in. I actually really like it above 120 again, and something to be watching out for. Right above that 120 looks super, super interesting. I'd be interested in getting long above that 120, and lo and behold, right, look at the criteria here. We have 10 EMA above the 20. We've been getting that retest of the moving averages. We look at the weekly. I assume we should have most of our criteria here. Yep, 20 above the 50 above the 200, right? A little bit of a pullback, so not a big deal. Yeah, Dell's actually a really interesting one. Let's talk about this a little bit. This could be a really nice trade idea to watch this play out. So super early signs of a reversal here, right? incredibly suspicious volume. I mean, 73 million volume. Dell just does not get volume like that. Starting to a nice move higher. This thing's probably going to gap up for MU's earnings. So, I mean, I don't even know how realistic it's going to be. In terms of targets, first one's going to be this gap here. Second one's going to be this gap here. I mean, that's your most realistic targets right now, is those gaps. Those are going to be the only places that matter. We could even take a look at the volume profile real quick and see if there's anything else super important. Oh, yeah. I mean, this is pretty nice. Yeah. So certainly, if you're not in Dell, it may be hard to get in tomorrow. Any retest above 120, though, for me, certainly would be a buy. And I'll actually even set an alert here. And maybe we'll get the opportunity to trade it. I'll set an alert on a retest of 120 and on a break above, and maybe we'll try and trade that tomorrow. Yeah. So me personally, I'd be selling a move right around into this 125. I'd be selling a move for sure into the 130s. That would probably be a good place to take all the profits in the short term. But this looks really good. Yeah, I really like Dell here. I think this is a great idea. Contract suggestion, somebody said. We can look. Dell can be a tricky one. Probably the October, you have the October 130s or the 125s. Definitely October, though. Nothing quicker than that. For me. Yes, I think you might be right about that, Brooks. All right, ARM, last one for you, Norman. Oh yeah. I mean, this is going to do the same thing, Norman. I mean, it's going to gap up tomorrow. Certainly, if you want to get in, you could buy a retest of 150 if it breaks above and retest it. But it looks good. Positively trending moving average. Nothing wrong with it. It's just yeah, odds are it's probably going to gap up. Everybody cool? Oh God, Norman. All right. No, I'm not gonna look at VST, Norman. I'm gonna look at Aaron CCL. All right. So let's run through the same framework. Let's look at the higher time frames. Clean this up. I have not looked at CCL in a while. All right, CCL higher time frame. Very clearly stuck right around this 19 buck level. You definitely don't want to get long right into that. The moving averages on the higher time frames are really close to turning positive fully. I mean, they're like a couple weeks away from being in a full uptrend. Definitely a weekly close above 19 is one you would want to be a buyer of. I mean, no doubt about that. Earnings coming soon in 2 weeks. Yeah, like you said, I don't know what. Oh, you said the 200 daily is flatlining. The 200 weekly is flatlining. If you were looking to buy a dip, this would be the place to do it, right at the 200 weekly, which I'll even mark that out, 16.83. This is what I like to do, 200 weekly SMA, color it yellow or orange, and show name on the right. Moving on to the daily. Short-term trend here. Yeah, short-term trend is up, but obviously getting a bit of concerning selling volume. This is 2 days of elevated selling volume as we break back below these moving averages. So not really a buy for me at this present exact moment based on today's close. Also, I mean, it's just getting stuffed right at that 19. Let's see if maybe there's something reasonable here that we could look at. If it came down to that 18, I wouldn't hate it for a dip buy, but probably would just prefer to wait until after earnings. But if you were going to trade into earnings, this would probably be one you'd be wanting to try and buy that reversal extension if you can get it. But yeah, CCL at a high level doesn't look bad. I wouldn't hate being patient though for that break above 19. Yeah, touch of the weekly 200. Me personally, I'd probably rather wait for that if it comes, or just a weekly close above 19. I mean, a weekly close above 19 realistically is probably going to be a cheat code or just a retest of that weekly 200. Also, probably a cheat code. It's not one that I trade much, so yeah, it doesn't really excite me. But anyway. All right, Norman. Last one. GEV. I mean, Norman, I think we talked about this, bro. This is just like straight up going parabolic. I don't really have anything to say about this, Norman. I mean, it's really not the place to buy this right now. So yeah, I don't got anything for you. All right, everybody. That's gonna do it for tonight. Appreciate you guys all being here. We'll talk probably next week about just a better framework for actually getting some trades formed off of this sort of framework. So anyway, thanks again for your time, everybody. Thanks for being here. Hope you guys all have a great rest of your night. And yeah, see you guys all in the next one.